Imagine you walk into your closet right now. You see that jacket. You know the one. You bought it 3 years ago for $200. You have worn it exactly 0 times. Every time you look at it, you feel a little twinge of guilt, so you leave it there. You tell yourself you will wear it eventually to get your money's worth. Now, imagine you open your brokerage account. You see a stock you bought for $200. It is currently trading at 60. You know, logically it is a bad company now, but you tell yourself you will hold it until it gets back to 200, just to break even. Here is the uncomfortable truth. Those are the exact same decision. And that jacket isn't just taking up space, it is a physical monument to a cognitive glitch that is likely costing you thousands of dollars in your portfolio. Today, we are going to fix your investment strategy by cleaning out your closet. The mechanism at play here is called the sunk cost fallacy. You've probably heard the term in Econ 101, but knowing the definition doesn't stop you from falling for it. This fallacy is the reason there are bad stocks in your portfolio and bad shirts in your closet. The problem is that our brains are wired to equate quitting with wasting. If you throw the shirt away, you feel like you wasted the money. If you sell the stock at a loss, you feel like you formalized a mistake. But today I want to introduce you to a different angle. I want you to view your closet as a portfolio. It is a collection of assets you acquired in the past. Your job is to manage that portfolio for the future, not to build a museum to your past decisions. By the end of this video, we are going to use the psychology of your wardrobe to rewire how you handle your money. If getting a better return on your capital and your closet space sounds like a good use of your time, go ahead and subscribe. Let's start with the cold, hard logic, because that is usually where we think we are operating. In classical economics, a sunk cost is simply money, time, or effort that has already been spent and cannot be recovered. That is the key phrase, cannot be recovered. The money for that jacket left your bank account 3 years ago. It is gone. Economically speaking, that money is irrelevant to any decision you make today. The rational rule of investing and life is that decisions should depend entirely on expected future costs and benefits. If you are a robot or a perfectly rational economist, you look at the jacket and ask one question. Does this item add value to my life starting from right now? If the answer is no, it goes. The $200 you spent is history. But you and I both know that is not how it feels when you are standing there with a trash bag. Behavioral economics gives us a much more accurate, albeit messier, definition. According to the experts, the sunk cost fallacy occurs when we continue a behavior or endeavor specifically because of previously invested resources, even if it is no longer the best choice. We stick with the losing stock, or the itching shirt, or even a bad relationship, because we don't want to feel that our past efforts were in vain. The Decision Lab puts it perfectly. They say our decisions are tainted by emotional investments. We are trying to avoid the pain of admitting a loss. So, in the closet, the rational mind says, I never wear this, it itches, get rid of it. But the sunk cost mind says, but I spent €80 on it, I should wear it. The result is a crowded closet where you wear the same 10 things, while 40 other items hang there, mocking you. You are emotionally stuck. And that emotional stickiness is exactly what Wall Street Prep warns about in investing. Continuing a strategy just because of the capital invested to date. Now, you might be thinking, Tom, so I have a few ugly shirts. Who cares? Why does this matter for my finances? Here is why. If you cannot master this emotion with a $20 shirt, you have zero chance of mastering it when your retirement fund is down 20%. The neural pathways are identical. And it gets worse. This isn't just about being stubborn. It is about a biological glitch in your brain that treats financial loss roughly twice as painfully as it treats financial gain. If we don't fix this, You are going to spend your investing career holding on to losers and selling your winners too early, which is the precise mathematical recipe for underperformance. To understand why we do this, we have to look at the three biases the sunk cost fallacy sits on top of. The first is loss aversion. This comes from prospect theory by Kahneman and Tversky. They found that losses loom larger than gains. Losing $100 feels about twice as bad as finding $100 feels good. When you look at that unworn coat, throwing it away feels like you are locking in a loss. As long as it hangs in the closet, the loss feels theoretical. Maybe, just maybe, you will wear it one day, and then the money wasn't wasted. That is a lie, of course, but it is a comforting one. In your portfolio, selling a stock that is down feels like admitting defeat. It makes the loss real. So people throw more money at bad decisions, what we call throwing good money after bad, just to delay that feeling of loss. We try to minimize the pain by doubling down rather than walking away. The second layer of this trap is the endowment effect. This is the tendency to value something more simply because you own it. There have been studies where people are given a coffee mug and asked to sell it. They demand a much higher price to sell the mug than they would have been willing to pay to buy it 5 minutes earlier. Why? Because now it is their mug. Ownership inflates value. In the closet, you look at that old blazer and think it is worth keeping because it is yours. You remember buying it. You possess it. Its perceived value to you is completely detached from its market value or its utility. In investing, this is dangerous. You overvalue your own stock picks. You think the market is wrong and you are right, simply because you are the one holding the shares. You become slower to sell losers because you have endowed them with a special status. They are part of your portfolio. This goes deeper than just psychology. We actually have fMRI evidence showing what happens physically in your brain. Studies have shown that sunk cost situations activate specific regions like the lateral frontal and parietal cortices. These are areas tied to risk-taking. But here is the kicker. When you think about wasting money or effort, your brain lights up the insula. The insula is a region involved in processing emotional discomfort and even physical pain. When you stand in front of your closet and think, "I can't get rid of this, I spent too much," that pang in your stomach isn't a metaphor. It is a biological distress signal. Your insula is screaming at you to avoid the pain of waste. And fascinatingly, neuroscientists have noted that people who are high in agreeableness and conscientiousness are often more vulnerable to this. If you are a responsible person who hates waste, your biology is working against your logic. That emotional signal can override the logical prefrontal cortex, forcing you to keep the junk. So, let's summarize the cocktail you are drinking every time you open that wardrobe door. You have loss aversion, making you terrified of finalizing a mistake. You have the endowment effect, making you think your old junk is gold. And you have your insula, physically firing pain signals to stop you from letting go. It is not just you being indecisive, it is a full-scale biological assault on your rationality. And the result is what I call the preservation of failure. We preserve our bad decisions rather than clearing the decks for new opportunities. I want to pause here. You might be thinking, okay, Tom, I get the psychology, but how does this actually look in practice? I want to do a split-screen exercise with you. I want to show you how your brain is playing the exact same trick on you in two completely different environments. On the left, we have your investment portfolio. On the right, we have your bedroom closet. Most people think these are different worlds. They are not. They are both asset management systems, and they are both currently being mismanaged by the same biases. Let's look at the left side of the screen. You hold a stock you bought at $100. It is now trading at $60. The company's earnings are down, The sector is shrinking, and the CEO just quit. A rational investor looks at this and says, if I had $60 cash today, would I buy this stock? The answer is obviously no. So the rational move is to sell. Take the $60 and put it into something with better growth potential. But the sunk cost mind says, I will wait until it gets back to 100 so I don't lose money. This is the trap. You are keeping capital trapped in a loser. You are missing the opportunity cost of what that $60 could be doing in a good index fund. You are trying to protect your past self from looking stupid, rather than helping your future self get rich. Now look at the right side of the screen. Your closet. You bought a jacket for €200. You never wear it because it's too boxy. A rational person says, if I wouldn't buy this today, it is just clutter. Out it goes. But the sunk cost mind says, I will keep it. Maybe I will wear it to a holiday party to justify the price. The result is mental clutter, decision fatigue, and wasted space. Just like the portfolio, you are holding onto a liability. Yes, clutter is a liability, because you cannot separate the current value from the historical cost. Narratively, your closet is your past self's portfolio. Your job is to manage it for your present and future self, not to defend the guy who made a bad purchase in 2019. We need to talk about the cost of keeping these sunk costs. In investing, the damage is obvious. Wall Street Prep notes that investors continue underperforming strategies because of what they have already put in. If you hold a losing stock for 5 years, waiting for it to break even, you have missed 5 years of compounding in the S&P 500. Let's say that dead money was $10,000. Even if it eventually goes back to what you paid, you missed out on potentially doubling that money elsewhere. That is the hidden tax of the sunk cost fallacy. It is not just what you lose, it is what you fail to gain. In personal finance, holding on to unused items follows the same pattern. You are tying up value. Maybe you could sell that jacket for $50. That is $50 that could be invested. Or, if you donate it, that is a tax deduction. By keeping it, you are effectively choosing to pay a storage fee for a memory of a bad purchase. But there is another cost that is harder to measure, but just as expensive. The cognitive tax. Clutter researchers have linked excess possessions to higher stress and decision fatigue. Every time you open a crammed closet, your brain has to process all that visual noise. It has to make a decision to ignore the 40 things you don't wear to find the one thing you do. This is a micro-stressor that hits you every single morning. The endowment effect and loss aversion make letting go feel painful, so we choose the daily micro-stress over the one-time pain of tossing it. But here is the psychological pivot I want you to make. At first, letting go feels like a loss. But once you see the freed space and feel the easier decisions, it starts to feel like a gain. When clients start to see the space they create, they often reverse the loss aversion effect. The gain of freedom becomes more salient than the loss of the item. So, how do we break this spell? Most people try to use willpower. They stand in front of the closet and say, "Be ruthless." And then they fail, because, as we discussed, their biology fights back. Willpower is not the tool for this job. You need a system. You need a set of rules that bypasses your emotional circuitry entirely. I have gathered 5 specific strategies from behavioral economics and successful investors that you can use right now. These work for your wardrobe, and they work for your brokerage account. Strategy number 1 is the most powerful. It is called the zero base rule, or reframing the question. The Decision Lab emphasizes reframing decisions around future utility rather than past cost. Here is how you do it. Pick up the item. Do not ask, "What did I pay for this?" That is forbidden. Instead, ask this. If I didn't own this right now and I saw it in a store, would I buy it for its current price? If the answer is no, then you are only holding it because of the sunk cost. It is a bad trade. In investing, you do the same. Ignore your purchase price. Pretend you are in cash. Ask, if I had this cash right now, would I buy this stock? If the answer is no, sell it. You are effectively rebuying it every day you hold it. If you wouldn't buy it, don't hold it. Strategy number 2 is surprisingly simple. Name the bias out loud. Asana's guide on sunk costs suggests that explicitly labeling the fallacy weakens it. When you feel that hesitation, say out loud, "Keeping this dress is a sunk cost fallacy." Or, "I am only holding this crypto because I don't want to admit I was wrong." It sounds silly, but neuroscience backs this up. Naming the emotion helps shift processing from the amygdala and insula, the emotional centers, to the prefrontal cortex, which handles logic. You are literally engaging your higher brain to override your lizard brain. You are calling out the glitch. It is like turning on the lights when you hear a noise in the basement. The monster disappears when you define it. Strategy 3 counters loss aversion directly. Remember, we hate losing, so stop framing it as a loss. Clutter clearing experts recommend focusing intensely on what you gain. Don't think about losing the shirt. Think about gaining the space. Think about the calmness of a closet where everything fits. Think about the money you get from selling it, or the tax deduction from donating it. You have to swap the mental frame. In your portfolio, don't focus on the realized loss. Focus on the capital you have freed up to put into a winning asset. You are not losing money. You are deploying soldiers from a losing battle to a winning one. You have to make the gain feel real to compete with the feeling of loss. Strategy 4 involves rules. Behavioral economists love pre-commitment. This means making the decision before you are in the emotional heat of the moment. For your closet, use the 1-year rule. If you haven't worn it in 12 months and it isn't a specialized item like a tuxedo, it goes. No debate, no maybe. The rule decides, not you. Another good one is 1 in, 1 out. Every new piece requires donating an old piece. For investments, this means setting exit criteria before you buy. If the thesis changes, I sell. If it drops 10% without news, I review. By setting the rule when you are calm, you don't have to rely on your willpower when you are stressed. You just follow the protocol you built for yourself. Finally, strategy 5 is a mindset shift. You have to accept that the loss already happened. This is the hardest part. Economically, sunk costs are already gone. Keeping the item does not reverse the loss. You can say this to yourself: the moment I bought that dress and never wore it, the money was gone. Your choice now is not lose or not lose. That ship has sailed. Your choice is keep losing space and mental energy, or cut the loss and move on. The loss is in the past. The stress is in the present. You have the power to stop the stress, but you cannot change the past. We have covered a lot of ground today, from the neurology of the insula to the math of the stock market. But it all comes down to one simple visual. I want you to go to your closet today. Find that one item, the one that mocks you, the one you keep just because you spent money on it. And I want you to get rid of it. Sell it, donate it, trash it. Feel that little pang of pain and recognize it for what it is, a chemical glitch in your brain. Then, feel the relief that follows. Once you practice this on your shirts, you will be ready to practice it on your stocks. What is in your closet and your portfolio should serve future you, not protect past you from feeling stupid. The money is already gone. The only question now is whether you keep paying in space, stress, and missed opportunities because of the sunk cost fallacy. If you found this breakdown helpful, do me a favor. Hit the like button so the algorithm knows this is good content. That's a small investment with a big return for this channel. And let me know in the comments, what is the one item in your closet you refuse to throw away? I bet you aren't the only one holding on to it. Thanks for watching, and I will see you in the next one.